This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 445 was produced on September 12th, 2024. I'm Eric Townsend. Bianco research founder Jim Bianco returns as this week's feature interview guest. Jim says it's official. The Fed has become political and risks a policy error. Jim also says the low for the 10-year could already be in, despite all the rate cuts purportedly on deck for the rest of the year. We'll also cover secular inflation, precious metals, and much more.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, September 11th, 2024. The September S&P 500 futures up 56 basis points, trading at 55.61. The market is in a holding pattern into next week's FOMC. We'll take a closer look at that chart and the key technical levels to watch in the postgame segment. The US dollar index up 44 basis points, trading at 101.72. The October WTI crude oil contract down 273 basis points, trading at 67.31. Another leg of selling, bringing it towards its multi-year lows. We'll take a look at that chart in the postgame, and Eric will have the EIA inventory data. The October RBOB gasoline down 306 basis points to 190, following oil lower. The December gold contract up 63 basis points, trading at 25.42, going on a month of consolidating along its highs. Copper is up 147 basis points to 414 after relentless selling over the summer, finally finding a fair value zone. Uranium up 88 basis points to 80.05, and the U.S. 10-year Treasury yield down 8 basis points, trading at 368, new lows in yields year to date. The key news to watch next week is the retail sales, the FOMC statement and press conference, as well as the Bank of Japan and the Bank of England monetary policy statements. This week's feature interview guest is Bianco research founder Jim Bianco. Eric and Jim discuss the coming rate cut cycle, China, the economic outlook, inflation, and more. Eric's interview with Jim is coming up as MacroVoices continues right here at macrovoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Bianco research founder Jim Bianco. Jim, it's great to get you back on the show. Last couple times that we had you on, you made the prediction that if the Fed did what they have now done, which is to wait until September before any rate cutting, they would risk the appearance of having become political. I'm going to go out on a limb here and say I think that they've crossed that Rubicon. The Fed looks political. What are the implications of that? Is it really change anything?
Yeah, no, the Fed has definitely become political. Let me back up and remind everybody what I said in our last conversation in May. Whatever the Fed policy was going into Memorial Day, were they tightening, were they holding, or were they cutting, usually will make it until Election Day. So to be clear, because people kind of misunderstand what I'm saying, if they were tightening going into Memorial Day, they could continue to tighten through the summer all the way to Election Day. If they were cutting, they could continue to cut. They were holding because their last move was in July of 23 with their last rate hike. So from July 23 to Memorial Day this year, they were holding. That would suggest they would hold through Election Day. Well, as we talk a week before the Fed meeting, with over 100% chance that the Fed will cut rates at their September 18th meeting, over 100% means we're debating whether or not it's going to be 25 or 50 basis point cut, not if there's going to be a cut. It looks like the Fed is going to break from its historical tradition, and it's going to cut rates in September of an election year. In other words, change policy in September of an election year. And that is unusual. It does look like it's going to be very political. The interesting thing about it is the Fed could cut rates and both candidates could winding up, criticizing the Fed for the same reason, that the Fed could cut rates and the Trump administration could put out something saying, see, the economy's falling apart. The Biden-Harris administration's done a terrible job. Even Jay Powell acknowledges it. And the Biden-Harris administration could say, well, why are you doing this before the election, to give them a talking point as well? So they're looking to be very political. So yes, they've decided to cross that Rubicon. Now, I've talked to some Fed officials about this exact topic, and their comment to me was, no matter what we do in September, we're going to be criticized. If we don't cut, we're going to be criticized. If we cut, we're going to be criticized. We might as well ignore the politics and do what we think is going to happen. And that seems to be what they're doing. They're believing the data that the economy is cooling and that a cut is warranted at this point. Final thing about this topic. I also said back in May, too, the line that the Fed is political but not partisan. So what I meant by that back in May, and I think it applies here, is no, they don't sit around the FOMC table saying, okay, and let's cut to the chase. We really want Harris to be president because they tend to be more Democrat than Republican at the Fed. So what can we do to get Harris elected? They do not do that. So I don't think they're partisan and they think of it in those terms, but they are political in that they are worried about their reputation. They are worried about the ramifications of their policies in Washington, and they care a great deal about that. But given what they've told me, and I think it's right, if they don't move, they're criticized. If they move, they're criticized. Whatever. If September 18th comes up, they're going to be criticized, whether they do something or don't do something. So they've kind of said that all cancels each other out. We've just decided that the data is cooling enough that it warrants a rate cut. And that seems to be why they're doing it.
Jim, you laid out a scenario for me off the air where China's economy actually figures into this whole story. Give us the backstory there. How does China fit into this story, and how does it affect the narrative?
So we'll talk about this a little bit later, but let me just say, yes, I've been bearish on bonds, and I still am for the moment. And I am very surprised that we've gotten the 10-year yield down to 366. Part of my surprise has been, I don't think you can make a case with the economic data in the United States that interest rates should be this low. So the question is, all right, let's look outside the United States. And what are we finding outside the United States? An acknowledged story that isn't maybe getting the coverage that it should. Chinese economy is in a world of hurt right now. It is really in a bad place. Their stock market is down over the last 2 years by over 25%. At the same time, our stock market is up. And I'll remind everybody that China still has rules on their books that if you are a research analyst in a brokerage house in China and you write a bearish report, you can be prosecuted. If you short sell their market, you can be prosecuted. So they are throwing people in jail that try to short their market or badmouth it. And it's still down 25% over the last couple of years. At the same time, the S&P is up 45%. Their interest rates are at an all-time low, 2.1% on the Chinese 10-year bond. Now, data goes back to 2005, but they are definitely at a 20-plus year low on that data as well. So that lower interest rates isn't saving their economy. Their second quarter GDP grew at 5%. Now, that sounds like a lot from Western market perspectives, but for high growth emerging markets like China, 5% growth, there's only 2 times in the last 45 years it's been lower than that. Tiananmen Square in 1989 and the COVID shutdown. And now, so their economy is in a world of hurt. Why does that matter? They're a bigger consumer market than the United States. They buy more cars every month than the United States or Europe. They consume more gasoline every month than the United States or Europe. If their consumer economy is really slowing, now you look over and you see Brent crude oil, the day we're recording, is under $70 for the first time since 2021. That's not an indication of what's happening in the United States. That's an indication of what's happening in China. If I look at the Bloomberg Commodity Index, that is approaching a 3-year low. That is an indication of what's going on in China, not necessarily an indication of what's happening in the United States and or in Europe. Now, what makes that surprising is the Chinese are command and control economy. They are a communist government. It's always been believed that the Chinese, a Politburo will send out the word down on high. Banks, please start lending money. People, please start spending money. Please start initiating new projects to keep the economy moving. They still have that ability to do it. And for the 25 years I've been watching the Chinese economy, probably Eric, like you have, every couple of years, people say, well, at one point, the Chinese are going to run out of the capacity to do that. Okay, I've heard that 15 times over the last 25 years. But maybe this is the time that that's finally starting to happen, and that the Chinese economy is really in a bad place. It is killing demand for commodities. It's killing demand for energy. Those prices are way down. And that's what you're seeing world interest rates respond to, especially in the developed countries, is that lowering of commodity prices and that lowering of energy prices, not because of what's happening in Europe and or the United States, but what's happening in China.
Now, one of the predictions that had been made for many years is that China had historically been a huge buyer of U.S. Treasury debt and that they would eventually stop doing that and it would cause all kinds of problems for the U.S. In many ways, that story already came true. They really have divested a lot of their Treasury holdings, but it has not caused any problems, any significant problems for the U.S., at least not so far. So are you saying that it's now about to start causing those problems? Is that where you're headed with this?
Well, I'll throw in the other side of the equation now, too. The Chinese holdings of U.S. Treasury debt actually peaked in 2012. So it peaked 12 years ago at about 1.2 trillion. I'm confident enough in remembering that number correctly. And it's down, probably 20% to a third. So they've been divesting themselves of treasuries for the last 12 years. Now, a big reason that they're doing that is, remember that, like the conveyor belt, that if you want to think of that metaphor, they produce product, put it on a boat, send it to the United States. We pay for that product with dollars. What are the Chinese going to do with all these dollars? Well, they're not going to convert them all to yuan. That would affect their foreign exchange market. So they recycle those dollars into U.S. treasuries. Well, the trade with China, especially since the trade wars under the Trump administration in 2018, is down. And COVID and the rebound from COVID never really recovered the pre-COVID levels. So we're buying less stuff from China. We're still buying a significant amount of stuff, but less than we used to. So that conveyor belt, if they send them stuff, we send them dollars. They recycle those dollars into the United States. They're still doing that, but they're doing that at lower levels, which is why their full holdings of treasuries has been falling. Now, on the other side of the equation, there's the new country that is the largest single holder of treasuries is Japan. And they've overtaken China a couple of years ago. And they have been constantly hoovering up treasury securities under the yen carry trade. So, borrow money in Japan at somewhere near zero interest rates, and then go out and buy something that yields more. Now, a popular product that they've been buying has been Mexican treasury bills, because Mexican treasury bills yield over 10%. So you can borrow at zero in China. You could buy a Mexican treasury bill that yields 10%. You have to take the currency risk. You can't really hedge it. And by the way, that trade has probably produced you more profit than owning the Nasdaq it actually has, until about a month ago when the yen carry trade started to get unwound. And now that's been putting that at risk as well. Now, wait a minute. Shouldn't that yen carry trade unwind in Japan, being the largest treasury holder, be bearish for bonds? Yes, it should be. But they're rallying. So they're rallying. There's something else that's going on there that seems to be a bigger positive in bonds than it is the negative of losing the yen carry trade in bonds. And I think that is the slowdown in commodity prices, the fall in energy prices, driven by the Chinese economy slowing. So to answer your question succinctly, yes, you should probably see them reduce their purchases of treasuries, but they have been for 12 years. But on the margin, what we really should be looking at is Japan, and whether or not they're going to change now that the yen peaked at 160 and it's pulled back, and there's some question about whether or not the yen carry trade will continue.
So will the yen carry trade continue, and what will the knock-on effects be to the U.S. economy? And while we're at it, let's also cover the landing situation. Are we at no landing, soft landing, or hard landing in the United States, and where are we headed with inflation?
All right, so as far as the yen carry trade, the answer is it should continue. It's still an attractive trade. Now, what happened to cause that unwind? July 31st was the Bank of Japan meeting. July 31st was also the Federal Reserve meeting. And the Bank of Japan met when all of us Americans were asleep. They raised rates 15 basis points. Now, they operate a little differently than us. The market thought that they'd raise rates between 5 and 10, and they raised rates 15. And they made some noise about that they might not be done raising rates. So the takeaway here is they surprised with a bigger rate hike than people thought and said there might be more of this. Well, if you're a levered trader, I am borrowing a lot of money in Japan, financing it at their funds rate, which is, at their repo rate, which was around 5 basis points or effectively zero, and buying a bunch of Mexican T-bills or US 10 years or something that's yielding a lot more and have no currency risk. I don't want uncertainty anywhere. So when the Bank of Japan surprises me by raising rates more than I thought, surprises me by suggesting that there might be more, surprises me that these rate hikes are strengthening their currency, weakening it against foreign currencies. As a levered yen carry trader, this is bad news for me. I don't want their currency to strengthen. I don't want uncertainty to cause volatility because I'm a very levered trader. I get out. And that's what drove the yen carry trade to be unwound. Where are we now? We're still at 15 basis points on their carrying cost or their official discount rate, the repo market. They've backed off after all of the market gyrations in early August about saying that they might raise rates more. They didn't close the door on it, but they became a little bit more ambiguous. And if I'm a yen carry trader, I'd have to look and go, they're still practically free money in Japan. Their currency ever settled out at whatever level it wants to, just volatility go away, I should get back into that trade. And I suspect that you might see a resurgence of that trade, largely because it still exists. The underlying fundamentals that make it attractive still exist. The only thing that's holding everybody back is the currency volatility, but that might not last much longer. So I suspect you will see another leg in the yen carry trade. Last thought on the yen carry trade. It's usually you borrow in Japan and you buy something with a yield. Well, you've got the 2-year note at 360 in the US. I've mentioned a couple of times, you've got 10% on 3-month bills in Mexico. That kind of a trade is what you want to do. What they're largely not doing is what everybody assumes they're doing. Oh yeah, we're borrowing in Japan at zero and we're buying NVIDIA or we're buying the Magnificent Seven stocks. Yeah. If you're going to buy the Magnificent Seven stocks, given all the volatility in those, you could charge me 5% of carrying costs, you could charge me zero, because those stocks are so volatile. That extra carrying cost and taking that currency risk is really not that important. So I don't think that you're doing that trade in Japan to find a way to buy, Microsoft or NVIDIA or something along those lines. Now, to your other question, as far as the economy, Wall Street likes airplane metaphors. There's the no landing, which is a recession. There's the soft landing, which is a recession. There's the no landing, which is the camp I'm in, which means that the economy continues to grow at its potential. In other words, it is just cruising along and it's not showing signs of any kind of a slowdown or a recession. And then there's that nebulous middle, the soft landing. And the reason I call it the nebulous middle is the soft landing has no real definition. If Wall Street forecasts a soft landing, it has a definition. Joe Biden says we're going to have a soft landing. In fact, he demanded that we're going to have a soft landing in the State of the Union address. And he said a soft landing just means the inflation rate's going to come down. That's all he thinks it means. And over the weekend, Janet Yellen said we're going to have a soft landing. And she had some 3-paragraph definition of what it was. And it's completely different from Joe Biden's definition. And it's completely different from Wall Street's definition. And I've often quipped, Wall Street loves to forecast the soft landing because it has no definition. So I'll tell you I'm going to have a soft landing. So in a year, I can give you a definition and tell you I'm right. Now that I've said that, I'm in the no landing camp. The reason I'm in the no landing camp is when I look at the U.S. economy, I don't see real signs of a slowdown. I see GDP growing at 2 to 3%. I see the Atlanta Fed GDP tracker is still saying that we're going to grow above 2% this quarter. Economists have a phrase called potential. It's not an observable measure, but it's what should the economy do if no one is slowing it down and no one is speeding it up? It should grow at what is known as its potential. That is estimated to be between about 2 and 2.5%. Well, that's exactly what it's been doing for the last 8 quarters. And that's what the Atlanta Fed GDP says it's going to be doing from here. And so therefore, when I look at the U.S. economy, I don't see many signs that we're in deep trouble. And so I still remain in the no landing camp, although being in the no landing camp, I am as frustrated as anybody else that we have a 366 at the time of recording 10-year note, which is very, very surprising.
How should we interpret what's happened with the Bank of Japan in terms of whether it was a policy error or it's, what we can expect more of and so forth? At least the way I experienced this whole thing, it felt to me like, first the BOJ hikes rates. They didn't think it was that big of a deal. The market freaks out. And it felt to me like the BOJ kind of came back mea culpa and said, we didn't really expect it to have that big of a result. We didn't mean it, guys. We're rolling it back. Is that not the right way to interpret it? Because it sounds from what you're saying like this really is an ongoing thing. The yen carry trade is back in full force. And the policy error that we thought might be leading to its demise is now forgotten. Is that the right way to interpret it?
All right, so I'm going to give you an answer that's probably going to get me in trouble with a cohort of people listening to this. Ueda, the Bank of Japan governor who runs the Bank of Japan, is an MIT graduate. He had he was there with Draghi and with Bernanke, all the central bankers, the economics department at MIT. And I like to quip that the MIT central bankers, if you say to them, hey, you've got this giant carry trade that's going on with your currency because of zero interest rates, they'll turn to you and say, oh yeah, well, show me the measures of how big it is. And I would say, well, when somebody engages in the carry trade and they write a trade ticket, there's not a little box in the corner that says yen carry trade, please tick it off. And therefore I could tell you how much there is of the yen carry trade. But intuitively, I can tell you that the underlying fundamentals and the strong circumstantial evidence that we see in the market suggests there's a giant carry trade around your currency and your funding rate. And the MIT graduates would say, oh, so you can't measure it. So maybe it just doesn't exist at all. Maybe you're grossly overstating the case, and I shouldn't worry about it that much. And then they go ahead and say, given the strong inflation in Japan, because inflation in Japan is finally above 2% on a sustained basis for the first time in decades, and the idea that it might stay there, they correctly looked at their economic data and said, maybe we should be raising rates and let's get going. And they raised rates a little bit more and said we should raise rates after that. And then the yen carry trade blew up. And the MIT grad said, oh, I guess there was one, even though we couldn't really measure it. And that's where I think they got surprised by it. So now everybody who's got an MIT grad is going to be hating me on saying that. Strong letters to follow. But I think that that's where their fundamental mistake was, which is why they did a bit of a mea culpa with it afterwards when we had all of the volatility. You may remember August 5th when the VIX index in the pre-NYSE hours got as high as 60 intraday, and the S&P fell 3% that day, was down almost 5% intraday at one point. That was all part and parcel of that toxic reaction to the yen carry trade unwind. So at least now those MIT grads over at the Bank of Japan will say, okay, maybe we can't measure it. I can't give you a chart to show you how big the yen carry trade is, but we'll acknowledge that that is a thing that they should have been a little bit more cognizant of. And the way you become a little bit more cognizant of it is you don't surprise the market. The Fed has a phrase for this, forward guidance. You kind of drop hints in the weeks leading up, and we might go 15 basis points. We might say that we're not done with that 15 basis points. We're going to keep going, and to leave the market with this impression that this is going to happen. And slowly over time, they could kind of adjust to that reality instead of surprising them all at once on July 31st on it. And again, the reason why in the US we didn't really notice it was, literally about 10 hours later was the Federal Reserve meeting. And that kind of sucked up all the oxygen on that day when it came to central banks.
Now, the other topic that you and I have discussed in past interviews has been secular inflation, and you've generally sided with me that we're more likely to be in a new secular inflation. Is that still your view? How has that view evolved since we last spoke? What do you see in terms of the secular inflation forces that are starting to press on the economy?
I still think we are still in a secular inflation. And to put that into, simple terms, I think the cycle turned in 2020. That the 40-year bull market in bonds ended when the 10-year note hit 50 basis points or 0.5% in August of 2020. I think that the inflation cycle bottomed at that point too, and that we've seen inflation go up. Now it hit 9% in June of 22. It's at, I'm going to use year-over-year CPI. It's at 2.9% now. It's expected the day after we're recording is going to be the August CPI is going to come out. It's expected year over year should fall to about 2.5% because you're dropping a very low number from the August 23 CPI number. And you're dropping a very high number from the August 23 CPI number because crude oil prices were a lot higher. And you'll probably replace it with a much lower number this month right now. So I think what you're going to see in terms of the inflation rate is it's going to probably go down around 2.5%. But I think cyclically, we're probably going to be at a low. We're not going to get back to the Fed's 2% target right now. So I've been of the opinion that the new level of inflation is somewhere between 3 and 4%. For the last 14 months, it has been around 3 or 4%. It looks like it's going to dip below that because of what they call the base effect here, because of what crude oil did to CPI a year ago. But I think this will be short-lived and will be, kind of rebounding later on in the year back to that 3% level. So I am in this idea that inflation is still not really behind us. Now that brings up something else that, kind of goes with what I was talking about with the no landing earlier. But what about the labor data, that the unemployment rate has gone as high as 4.3 and now it's 4.2, that we triggered what is called the SOM rule, Claudia Som's rule, that when the 3-month average of the unemployment rate gets 0.5% above its 1-year low, that the U.S. economy is already in recession, that we had a big revision down in the payroll report of 818,000. There's a debate on Wall Street, and this goes to really the secular inflation story, that we have a measurement problem with the labor market. And that measurement problem is because the way we measure the labor market is through surveys. We do the household survey, asking 60,000 households, how many people in those households have jobs, how many people are looking for a job. From there, we calculate the unemployment rate. We do an establishment survey. We survey about 1/3 of the payroll force. So it's about 65, 70 million people, I think. Actually, it's more like around 55, 60 million jobs. We survey companies that employ about 55, 60 million people every month. And we ask them how many people they're employing. And from there, we get the non-farm payrolls report. These surveys are adjusted by population. Well, up until 2020, demographers could pretty much give you a very good estimate of where the population was going to be next year, the year after, the year after that. That changed in a dramatic way around 2021, and it changed because of migration. In 2020, 2021, the U.S. population was growing at 0.2% or 20 basis points a year. In 2024, it's going to grow at something around 1.1 to 1.2 or 110 to 120 basis points. That would be a 30-year high and a dramatic turnaround and a big surprise. Where is all this population coming from? There's no baby boom in this country. It's coming from migration, coming from people coming over the southwest border. The unemployment rate, the non-farm payrolls report, and the rest are good surveys assuming that the population growth of the country is low, stable, and predictable. It's high, chaotic, and unpredictable right now. That brings into question whether we're actually measuring the labor market correctly. And again, it's because of this giant population growth. And I'll give you an example. In the payroll report revisions that came out 2 weeks ago, 818,000 reduction. And that was spun by there's 818,000 less jobs than we initially thought between April of 2023 and March of 2024. That was the revision period. Those revisions came from looking at tax returns and unemployment data in tax returns. Goldman Sachs pointed out that their estimates are what happened was there was actually a reduction of around 300,000 jobs, but the other 500,000 were people getting paid under the table. So what we wound up doing was we wound up basically getting rid of higher cost employees that withhold taxes and replacing them with cash employees that we pay under the table. And that what Goldman's point was is that a majority of those jobs were not lost. They were replaced with people that are not paying taxes. Remember, it was tax returns and unemployment insurance on tax returns that drove those revisions. Well, if I'm paying people under the table, they're not showing up in tax rolls. So the correct assumption is we lost 818,000 jobs. If the population growth was low and stable and predictable, that would be a good assumption. But since it's highly chaotic and unstable and unpredictable, that assumption should be called into question. Where do we see this in the data? If you look at the retail sales and the consumption data, the U.S. economy is seeing people spend money like crazy, seeing that retail sales are going very strong. We're seeing the savings rate falling as well. And people are surprised by all this consumption. And no, it's not just that prices are up, because this is after inflation data we're looking at. Maybe another answer could be that there's actually more jobs in the United States than we think. Because what is the biggest thing that drives consumption or retail sales? You have a job and you have a paycheck, and you go and you spend money at the store. Even if you're not a citizen of the United States and paying taxes, you still have a job and a paycheck that you can spend money at the store, which is why we're seeing such strong consumption numbers, which is driving the economy. So if the economy is stronger than we think, and if we're having a hard time getting to that 2% target, then looking at the data, I think what we're seeing is a situation where the economy might be stronger, might be pushing demand, might be keeping those inflation numbers up. Now, there will be a seasonal base effect dip here because crude oil prices got to about $95 in September of last year, and that held up all of the inflation numbers. But I think once we get beyond this, we might see the inflation numbers rebound back into that 3 to 4% range. We're there right now. We're 2.9 and change. And that we are still in a much higher inflation era. And if the Fed is going to conclude the labor market data is cooling and it's not a measurement problem, and they're going to start cutting rates aggressively, and the market is going to signal to them, you need to cut rates 10 times, I fear we're going to overdo this. And I fear we're going to stimulate, and that the second half of 25, we're going to be back to an inflation problem again. Not just that, no, we're in a 3% inflation world, but we might actually be in an inflation problem.
Okay, hang on a second, Jim, because as I take a step back from all this, what I'm hearing above everything else is there's a huge disconnect around rate expectations. Almost everybody is, just chomping at the bit, waiting for that announcement to come where the beginning of the cutting cycle happens. And don't worry, there's going to be a whole bunch of these rate cuts coming. It's going to be 1, 2, 3, 4, 5, a whole bunch of rate cuts coming. There's going to be 5 or 6 rate cuts. We're going down 300 basis points. Sounds like you're saying really at least on longer term rates, the 10-year rate, any effect it was going to get has probably already been baked in. Is that right?
Yes, that is right. As a matter of fact, I'll even go you that Citibank is predicting that the Fed will cut rates 125 basis points before the end of the year. So that's 5 25 basis point cuts over the next 3 meetings. Simple math says that's 50, 50, and 25. The order to be determined. At the moment, it looks like maybe 25 in September, and then a 50 in November and a 50 in December. So the reason I bring that up is, yes, everybody knows or everybody expects the Fed is going to cut rates in September, and it is going to be the beginning of a big campaign to lower interest rates and lower them a lot. That is why the funds rate at 5 to 5.25, call it 5.375, the midpoint of it. And the 2-year note, as we are talking right now, is trading at around 360. So the 2-year note is trading 175 basis points, 180 basis points below the funds rate. The last time it traded this far below the funds rate was the financial crisis of 2008 when everybody was panicking, the world was falling apart. What it tells you is, yes, you're going to get 7, 8, 9 rate cuts. Market's already priced it in. So if you get 7, 8, 9 rate cuts, in theory, the bond market should be unchanged for the next year while the Fed cuts rates 9 times. What's going to get a further rally in bonds? That would need 10, 11, 12, 13 rate cuts. That would mean we're going into recession. What would be a good signal that we're going into recession? If you saw credit spreads widening, if you saw the stock market sell off well in excess of 10%, neither one is happening. The stock market's around 4% off its all-time high, which was set in July. And credit spreads are tight relative to the last couple of years. They've widened a little bit, but nothing meaningful. So none of that is happening just yet right now. So you've kind of got interest rates as an outlier to credit and to the stock market in terms of what it's signaling. Again, I think it's about collapsing commodity prices because of China is what's been the catalyst for interest rates and why it's not, showing up in terms of credit spreads or it's showing up in terms of the stock market. And if you get any kind of normalization in the bond market, what is normalization? Well, where should the 2-year note trade if the Fed cuts rates 7, 8, 9 times? It should trade at a premium above the 10-year note, above the funds rate. So if the funds rate goes to 3.5, 200 basis points, 8 rate cuts, 2-year note should trade at 4%. It's at 360 right now. And if the 2 years at 4%, where should the 10-year be if the yield curve is uninverting? It should be 50 basis points above that at 450, not 365 or 366 where we are right now. So yes, the answer could very well be the Fed's going to cut rates in September. That's going to be set off of 7, 8, 9 rate cuts. And if that happens, interest rates go up 100 basis points because we've already priced all of that in. Now, if you want to make the case that they're going to go a lot further, then you got to make the case the U.S. economy is falling apart. I'm an Olander. I don't see it. The stock market doesn't see it. The credit market doesn't see it either.
I'm going to go out on a limb here, Jim, and say that if you're right, it's a pretty big surprise in the sense that, most people are not expecting what you're talking about, for there to be no material change in longer-term rates after there's maybe as many as 8 Fed policy cuts. If I'm right about that, or if you're right and the result of that is that people are caught off guard and surprised, what's the consequence of that surprise going to be?
So you're just to the first half of your question, you're right. If you look at the Bank of America Global Fund Manager Survey, they've got, they've been asking the question for nearly 25 years of, something like 200 global fund managers every month. their outlook on various things, including long-term and short-term rates, and they've never been more bullish than they are right now. If you look at the Commitment of Traders report and you look at unlevered asset managers and the 10-year note futures, they're the longest they've ever been. If you look at the TLT ETF, which is the iShares 20+ Treasury, there's been massive inflows into that instrument as well. People think that the Fed is going to cut rates in September, even though interest rates are down 140 basis points from their peak a year ago. They think, no, this is just the opening inning of a massive rally. Now, what gives them that belief that it's the opening inning of a massive rally, which is why they're all so bullish in all these surveys? Because they don't think the 40-year cycle ended in 2020. They think that we are going to have many more episodes of going to zero interest rates and quantitative easing again and again and again, and that is the normal course of affairs as we move forward. And that's where I differ from them. I think that secular era is over right now. And with that secular era being over, I think that it's going to be very difficult to get interest rates down that 7, 8, 9 rate cuts unless you see serious and protracted weakness in the U.S. economy, U.S. credit market, and U.S. equity market, all three of which are not showing that, in my opinion, just yet.
How should we be thinking about the long term of what is normal? Because certainly for the last several years, near zero interest rates have been normal. Of course, you and I would say, well, that's not normal. That's only been for the last few years. The normal was established in a much longer time frame. But certainly there has been something over the last 10 years or so, post-2008 financial crisis, where it seems like there is a decided new normal, where the central bankers have a different participation level than they used to in the economy. Does that mean that we are in a new era where central bank participation is going to be more important and rates are going to be lower, or are we moving back to historically normal interest rates?
I would answer this. Short answer is we were in a new era that ended in 2021, 2022. Now, let me explain. And I'll use Austin Goolsbee, the Chicago Fed president. Austin Goolsbee is one of the bigger doves at the Fed and has been very adamant that the Fed needs to cut interest rates. And he's been adamant that the Fed needs to cut interest rates because he looks at real rates. That would be interest rates less inflation, and says that real rates are way too high. And because real rates are way too high, that is a restrictiveness on the economy that is slowing things down. And he would point to the labor data as a sign that these real rates are slowing things down, although I would argue there's a measurement problem because of population growth, as I explained earlier. Well, here's the question. From 2009 to 2022, interest rates were at zero. We were in a quantitative easing era, and real rates averaged from 2009 to 2022. And for those that want to know, I'm talking about the federal funds rate minus core PCE. That's the Fed's favorite inflation measure. That rate averaged minus 1% from 2009 to 2022 during the QE period. Well, we're not in a QE period. We ended that. We're in a QT, quantitative tightening period, where the Fed has been reducing its balance sheet. So what is the appropriate interest rate when you have inflation and you have quantitative tightening? Well, what was the average real rate before 2009? From 1982 to 2009, it was 2.6%. Today, real rates are 2.8%. They look a lot like where they were, pre-QE. So this does bring up an interesting debate. What is the neutral funds rate, or where should interest rates be? Some on Wall Street think zero. Of course, they have to be zero because that's where they were from 2009 to 22. Yeah, well, we're not doing QE. We're doing QT. We're reducing the balance sheet. We're no longer in a ZIRP period, a zero interest rate policy period. And Jay Powell himself has said in some of his press conferences, he doesn't think we're ever going to go back to that unless we have some kind of huge, massive economic crisis, which is what we are not having right now. So it begs the question, where should interest rates be? Well, if you look at the pre-QE period, real rates are not that far off the average of the pre-QE period, even though Austin Goolsbee he's been screaming, we're at nearly a 20-year high in real rates. Oh my God, look at what it's doing to the economy. What? The economy's fine. It's growing at trend or potential for 8 quarters in a row. And are you telling me that real rates should maintain that minus 1% range that it had during QE when we're not doing QE? Or should they be closer to about 2.6 and they're at 2.8? This brings up a adjacent argument. What is the neutral funds rate? Well, the Fed forever used to say that the neutral funds rate was 2.5%. How'd they arrive at that? 2% long-run inflation target, which they still believe and a lot of Wall Street still believes. I don't. I think it's more like 3. And a 0.5 basis point R star on top of that. So you take the long-run inflation rate, add a 0.5%, fudge factor, or they call it R star, reals on top of that, and you get 2.5%. Well, the Fed has been moving that target up. It's up to 2.75. When Jay Powell was asked about it at a recent presser, I think the June one, he said, oh, this is just a kind of a thought experiment, a theoretical exercise, and the like. No one really, thinks more of it than that. And I disagreed. I profoundly disagreed with him. And I understand why he said it. He said it because what it's implying is a belief that maybe we're not going back to 2% inflation. We're going to go to 2.5% inflation or 3% inflation so that neutral funds rate needs to move up. And then Mary Daly at the San Francisco Fed came out and said, our star might be closer to 1%. Well, if you've got a 3% to 4% inflation target, like I've got, and you put 1% R star on it, that means that the neutral funds rate is 4. A lot of people on Wall Street would argue that they could see that the neutral funds rate is 3.5 to 4. Well, let me go back to what I said earlier, that Citibank is saying we're going to get 525 basis point cuts by December 31st. That puts the funds rate at 4 to 4.25. If I go with Wall Street's estimate of neutral, 3.5 to 4, we might be in 90 days close enough to what we would refer to as neutral. We should be done with this rate cutting cycle in 90 days, should be done with this rate cutting cycle in 90 days because we'll be near neutral. But the expectation is, no, this is the early innings. So we're going to go 7, 8, 9 rate cuts. And we're going to go way too far and be way too stimulative and wind up with, like I said, an inflation problem in the second half of 25. Now, I would like to see the Fed address this issue. Why do you still think we have a 2% inflation target? Give me some arguments. Why do you still think that the long run rate is 2.75 to 2.5 when everybody else, and even market measures of the long run inflation rate, are much higher than that? Give me some arguments. The Fed doesn't. They just say, look, it's been 2.5 forever and it's just going to stay there because remember, the Fed's not partisan but political, because politically it's a good number for us, and we'll just go with it. Although no one other than the Fed says that that's how far they have to go back to neutral, and they've all cranked themselves up that there's going to be a lot of rate cuts as we go forward from here. And the risk is, if you can't answer the question as to where neutral is, you're going to start a journey on September 18th. What's the destination? If you can't answer what the destination is, you're going to go too far. And that is the real risk that we face that hasn't yet to be really, articulated as to how far we're going to go and where we think we should stop.
Jim, I'd like to tie these rate expectations into precious metals because it's a subject that many of our listeners, have a trade on in. So on one hand, it seems to me like the reason to be long gold, or the reason that a lot of people are long gold, has a lot to do with rate cut expectations. A lot of people think that will be a bullish catalyst. Are you saying that they've got the story wrong and that we shouldn't be long gold here, or is it more complicated than that?
No, I think that we've got the story right. I mean, with gold, in previous calls, I've been a frustrated gold bull. I've argued gold has got every reason in the world to start rallying, and it seemed to not really find any reasons to rally. And then around February, it really started to take off. I look at gold as being one of, it hedges you against one of two things. First of all, it hedges you against bad things and uncertainty. Monetary policy is running well into the uncertainty camp. And I would argue, where's that uncertainty coming from? You're going to cut rates, and you haven't articulated where you need to go. That's the last thing we were just talking about. So if you just start cut, like I said, we could be in the second half of 25 and go, whoa, we went way too far in the other direction here. And now we've got a problem, and that benefits gold as well. The other thing about gold, I've said too, is to my frustration with gold, is that we've turned it into a quasi-fiat currency. You know, we trade ETFs on it, we trade derivatives on it, we trade futures on it, that it kind of moves up and down like a fiat. Well, maybe what we could be doing now is finally breaking of that cycle, and that if we're going to wind up with a policy error, and that's what I'm suggesting, is that there's a real risk of a policy error if this is the start of a big, massive rate-cutting campaign, from what I see. If we wind up with a policy error, then maybe we could finally break gold of that fiat currency thing that it trades on an ETF, it trades in the futures market, and it starts acting like it's traditional hedge store of value. I think that's what we've been seeing in gold with the rally that we've seen over $2,500. And all of this seems to be very, very supportive of gold. And I also would find it interesting to point out that in the last 5 or 6 years, we've had some epic stories. I've even said this with you on previous calls, right? Peter Schiff's dreams have happened in the last 5 years. We have had a pandemic. We have had 9% inflation. We have had gyrations in markets like we've never seen. And gold could not get out of its own way. And then starting in February, when everybody started talking about, nope, the Fed's got this policy all wrong, and they've got to start cutting rates like mad, gold finally started to take off. And to me, it sounds like, if I had to interpret the gold move, it's in the policy mistake camp like I am, and it is the policy mistake hedge. And that's what's got it up over $2,500, up a lot from February. And as long as we're continuing down this road, it should be very supportive for its price.
Well, Jim, I can't thank you enough for a terrific interview, but before I let you go, please tell us a little bit more about what you do at Bianco Research. You're a boutique institutional research firm, so for our institutional audience and for our better-heeled family office and private investor audience, they can afford your institutional price tag. Tell us a little bit more about what's on offer.
So 2 business lines that we're in. We're in the research business. That's our traditional line of business. That's BiancoResearch.com. It is an institutional product, as you said. I am active on social media at Bianco Research on YouTube and on Twitter, and Jim Bianco on LinkedIn. The other product we started about a year ago is we manage an index called the Bianco Research Total Return Index. This is an index designed to outperform the broader bond market benchmarks like the Bloomberg Aggregate Index or the JP Morgan Broad Investment Grade Index. And there's an ETF run by WisdomTree that tracks our index. Think the S&P Index Committee manages the S&P 500 and the SPY tracks the S&P 500. Well, we manage our index. We intentionally try to change the duration and the credit weightings and all of the other metrics in that index to outperform. And WTBN, the WisdomTree Bianco Index, WTBN, tracks our index. Our index is now up over 5% this year. It is outperforming some of the larger, broad investment grade benchmarks we're trying to beat. And if you want to find out more about our index, you could go to BiancoAdvisors.com, and it lays out a lot about our index and that line of our business. And BiancoResearch.com lays out about our research business. And again, you can follow me on all the socials because I'm still fairly active on all of those.
And again, that ticker symbol is WTBN, Whiskey Tango Bravo November. Patrick Ceresna and I will be back as Macro Voices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Jim. Nickel Arnick is away this week. Now let's get to that chart deck. Listeners, you're going to find a download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jim's picture saying looking for the downloads. Now, Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build of 833,000 barrels, but Cushing, Oklahoma saw another great big drawdown of 1.7 million barrels. That's really putting Cushing right on its operational minimums and challenging the ability of that facility to perform its blending operations and do the other things that they do there. But the finished products were the big builds on the board, with gasoline building 2.3 million barrels and distillates building another 2.3 million barrels for a net petroleum build of 3.7 million barrels on the week. U.S. production held steady at 13.3 million barrels. The market sold off hard to a low 65 handle on plenty of OPEC spare capacity, talk of ending the cuts, and recession fears. This could persist, and we could easily trade much lower from here, or it could turn around on a dime in any sort of escalatory news on one of the global geopolitical conflicts.
Eric, certainly spare capacity and recession fears have been driving the short-term weakness in oil, but technically there's an interesting point here. We are quite oversold technically as we now approach the three-year lows. As we come to this support line, this is often where there are technical bounces from oversold conditions. This would result in a potential counter-trend rally that could easily find us in the mid-70s. From this incredibly oversold range. Now, that doesn't necessarily make it bullish. I mean, it offers a swing trade, counter trend reaction. But in order for oil to establish a bottom, it could probably end up taking us deep into the fourth quarter as we establish a base and support lines for which the trend could eventually turn up later in the year. Moving on to equities here, Eric, what's your thoughts?
Well, after a perfect test of the 100-day moving average on this little correction that we just had, I'd like to see the S&P close over 55.66. That's 5566 on the futures contract. That would be the 13-day moving average. Above that level on a closing basis would confirm that this bounce has legs, which I think it probably will.
The S&P 500, it continues to be bought on dip each time it tries to correct that big rally since the August low. Overall, the market is in a holding pattern and entering a period where there's a huge pivot coming with the FOMC meeting, and the likelihood that market stays in this holding pattern until the FOMC is very likely. Odds of us making a fresh new high prior to the FOMC is something I wouldn't assign a high probability to. Overall, we should end up seeing relatively, while volatile, but more of a range-bound volatility this coming week. It will all be a setup for, will there be some sort of inflection point from the FOMC meeting that spurs either a bull breakout or a breakdown? My inclination remains that we're seeing a bigger topping formation developing. Even if the market tests its previous highs and even or prairie dogs that high, it is something that I don't think is going to be bigger picture sustainable until we go through a deeper, more pronounced consolidation and or a bigger correction. I wanted to highlight on pages 4 and 5 the breadth of the market. On page 4, I have the New York Stock Exchange percentage of stocks above their 50-day moving average. And on page 5, I have the Nasdaq one. And what we can see here is the breadth of the market remains quite weak. On the New York Stock Exchange, we're at 54% of stocks that are trending higher right now. And when we look at the Nasdaq, we're sitting much closer to 39%. So actually, the majority of stocks are either in a downtrend or not participating on the upside. This type of breadth can be looked at two ways. One, if the breadth was to return, it could be the fuel for a bull advance. Another view, though, is that this is continuing to show that there's underpinning distribution going on in the market to support the idea of a topping formation. Overall, I think that the market is relatively thin here, and I think that overall, the bigger tops in the market are likely in, and it's just about waiting for that FOMC inflection point or other type of a catalyst that could spur the next major volatile move. Now, moving on to the dollar, what are your thoughts, Eric?
We seem to be consolidating between 100 and 102 on the Dixie. A daily close below 100 would be a welcome and strong signal that the new downtrend in the dollar is still firmly in play.
On page 6 of the dollar index chart, Eric, and what you can observe here is that we are trading at multi-year lows, very similar to where we are with crude oil. And the big question, of course, is will the ECB and or the FOMC become a catalyst for potentially a further deterioration in the dollar lower? Typically, when you reach major support lines, again, technically, the market offers a reaction. It's usually counter trend, fib retracing. We can be testing the 50-day moving average near the 102 to 103 levels above. But if that continues to demonstrate distribution, especially in the post-FOMC period, ask the question as to whether there's one full leg lower coming in the dollar. Now, every time we've been at these kind of lows in the last 2 years, a meaningful counter trend rally back up to the top end of the trade ranges was the result. We're currently at the key inflection point with the FOMC making their interest rate pivot. It'll be interesting to see whether that results in any meaningful trend shift. And moving on, I want to talk on page 7 on that gold chart.
Well, we were back to testing cycle highs until the inflation data put a damper on the market on Wednesday morning. The slow stochastics, though, are about half-mast now and pointed sideways as compared to extreme overbought a couple of weeks ago. So about half of the froth has now come out of this market. I remain extremely bullish long-term. The thing is, there's just plenty of scope. $100 down from here would not violate the primary uptrend. Gold doesn't really become a strong buy until about $24.80 or so, well below the current market. So we're right on the high end of the channel, and I think we'll eventually break out higher. But right at this point, it's hard to justify to adding to longs because we're really kind of already right at the resistance level.
It's an interesting pattern in a sense that gold remains clearly in bull trend. Higher highs, higher lows, staying above its moving averages, staying above its ascending trend lines, everything that indicates bullishness. But we're in a 1-month consolidation along the highs, and that usually unwinds any overbought state. The path of least resistance is for this to remain in its prevailing trend, which is a bull breakout that could see us get up to 2,700 on the upside. The bigger question, of course, will we see that kind of a bull breakout here? I want to say that, give it the benefit of the doubt that the bulls will prevail, but any corrections that happen, so long as these corrections stay above those March, April, May highs, which are all just above 2,400, then you can approach gold with a buy on dip mentality and see whether or not the bull trend continues. Now on page 8, I have that chart on the copper futures, and what's interesting is that copper has been in a pretty pronounced downtrend and stayed below its 50-day moving average for the last several months, and with major supports lying still substantially lower, like 10% plus on the downside. But yet we now have a temporary break above its 50-day moving average. I remain generally skeptical that this rally will stick beyond, let's say, a quick pop to 440 and just retrace some of the very oversold conditions. But I still am in the camp where, though on the bigger picture, there's all sorts of amazing bull cases to be made on copper. It's very likely to spend a lot of time grinding it out for the next few months and establish meaningful trading bottoms that inevitably will lead to the next bull breakout. The question, of course, is that will this bull breakout stick? And my view at this moment is that I am highly suspect that this is going to be potentially a false breakout if it does. Now, Eric, let's talk uranium.
Okay, first let's explain the news. The catalyst for the big spike up in the uranium miners on Wednesday was reports that, exactly as our friend Justin Hune over at uraniuminsider.com and several other experts had predicted correctly, they anticipated that Vladimir Putin would end run any possibility of waivers to the import bans that the U.S. Congress imposed on Russian uranium by simply considering export bans from the Russian side, effectively upstaging the Americans. That would be consistent with exactly what Justin predicted, and I think he got that call exactly right. So kudos to Justin and Rick and the team over at at uraniuminsider.com. But now we get to find out, was this reaction that we saw on Wednesday in the market for uranium mining shares just a pop-up reaction on the news, a knee-jerk that's only going to retrace lower as we find still lower lows still ahead? Or was this the beginning of a major trend reversal that everyone's been waiting for? Well, needless to say, it could go either way. The bear argument is the technicals. All the moving averages are pointed down and sharply down. We took out the 61.8% fib retracement level to the downside on the big move up on URNM, the biggest ETF in the sector. So that was on the big move, last year's big bull market up. We've already gone beyond the 61% fib retrace. So oftentimes you go past that level, you go back to 100%. That could mean that last year's lows are the next target lower. On the other hand, the bull case, World Nuclear Association conference in London is over now. The mood was reported as extremely upbeat, and it's buying season in the term market. So, maybe that big turnaround that everyone's been waiting for. Justin just nailed the call on Putin end running the United States with respect to putting out export bans ahead of our import bans. Maybe he'll also get the call right on the market bottoming. He didn't quite say that in his last subscriber video, but it sounds to me like he's very much of the mindset that we're close to bottoming, if not already past a bottom here. So hopefully he's got that call right as well. We'll see what happens.
The only technical observation I want to make is it really feels that while the primary downtrend, which has been dominant all year in uranium, is still the path of least resistance and the trend and the channel that continues to be intact, but we have finally seen divergent momentum. The downside selling pressure seems to have subsided, and while that doesn't result in buying pressure, we really don't see any motivated selling taking down prices to even lower levels. The bigger question is, have we found like a fair value zone here on uranium where this is where some of these consolidations will inevitably lead to a trend shift? I think this is one that should be high on members' watch list to see whether or not this trend starts to shift in going into the fourth quarter. Finally, I wanted to just touch on page 10, the 10-year Treasury yield, and what we see is continued breakdown in yields. And while this has been a relentless trend, just like Jim was suggesting, it's getting a little bit crowded, and a lot of people now have priced in a lot of easing. The bigger question, will the FOMC meeting be an inflection point that causes mean reversion? Does that basically everyone realizes, oh, maybe we priced in too much, and then it begins a little bit of a counter trend move. Now, I don't want to make a call that that's what we will see, but it is going to be really important watching how yields do react to FOMC, because if we find ourselves back to 4% in a span of a week or two afterwards, then we have to really ask ourselves, where can the 10-year yield head to in one of these kind of consolidations where they're pulling back out some of the dovishness that the market has been pricing in.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
In this week's Research Roundup, you're going to find the transcript for today's interview, as well as the chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this and so much more in this week's Research Roundup.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at MacroVoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.